Welcome to Breaking News to Trading Moves. Today, we are looking at the outlook for Deere and Company. That's ticker DE.
Right. And specifically, what their performance and strategic focus might mean for the rest of the agriculture and industrial markets.
So for you, the listener, we've looked at the information around Deere's stock recovery, their earnings targets, and the whole environment of global tariffs.
And our goal here is to identify some specific companies in related industries that, might be positioned to gain.
And on the flip side, those that may face some headwinds.
Exactly.
The news item that's really getting this conversation started is that Deere is eyeing a recovery. They've got positive earnings guidance, a clear focus on those 2030 growth targets.
But they're also managing all this trade uncertainty, the tariffs.
Yeah, and that situation, it impacts everything from farmer spending to industrial costs, really across the board.
So let's start with the winners.
Let's do it. Let's start with the companies set to benefit. And I think we have to begin with the core sector.
The most direct one, for sure, agricultural equipment manufacturers.
This group benefits directly from Deere's positive guidance, right?
Yeah, it's not an isolated event. It suggests the whole farm economy is pretty robust. If the market leader is confident, the whole sector usually feels that.
So is it just about farmers replacing old equipment, or is there something else going on, a calculation?
Well, it's often a calculated move. Farmers are looking ahead.
Ahead to what?
To potential new tariffs, maybe some new regulations coming down the line. That gives them an incentive to spend now.
Ah, okay. So they're locking in the price on a big combine or a tractor this year.
Before inflation or, some new rule adds to the cost later on. Makes a lot of sense.
So that puts Deere and Company, ticker DE, at the very top of our list.
Naturally. But it also helps their peers who are riding that same wave of optimism.
Okay, so who else are we talking about?
We're looking at companies like Caterpillar Inc., ticker CAT.
Okay.
They benefit from that general strength in industrial sectors, including agriculture. And then you have AGCO Corporation, ticker AGCO.
A pure play agriculture company.
Exactly. They're a major global player, so they feel that positive sentiment from the farming community just as much.
All right, so let's move beyond just the big iron. A crucial part of Deere's strategy is this focus on connected machines, platform strategies.
Yes, this is a key observation.
It sounds like an opportunity for the whole AgTech sector.
It is. Deere isn't just selling equipment anymore. They are positioning themselves as a data service provider. They want recurring revenue.
So they're building advanced sensors, GPS, specialized software into basically everything they sell.
Precisely. The farmer buys the machine once,
but then pays a subscription for the mapping data, the yield optimization, the automated steering, all the things that make the machine run efficiently.
That's the model. And that shift generates really valuable recurring revenue streams for the firms that supply those precision tools.
And when the market leader commits to it,
everyone else has to accelerate their own digital plans. It validates the whole business model for the industry.
So for precision agriculture and AgTech providers, the list starts with CNH Industrial NV, ticker CNH.
Right, a key competitor who is also pushing hard into connected solutions.
Then there's Monsanto Co., ticker MON, though we should say they're now part of Bayer.
Yeah, and their role here is on the data side for seed and chemical application. You need synergy between the equipment and the inputs.
So the tractor's platform needs the seed company's data to optimize fertilizer use correctly.
You got it. And the last one here is Toro Co., ticker TTC.
A lot of people probably think of them for lawnmowers.
And they'd be right. But Toro has also developed a lot of high-tech precision irrigation and specialty ag tools that really benefit when this platform model gets more accepted across the industry.
Okay, so the machines are getting smarter, more complex, but they still need to be built. Let's talk about the supply chain.
Let's pivot to the industrial component suppliers.
Yeah.
We're talking about the ones who make the really sophisticated parts for these connected machines.
So not just nuts and bolts. We're talking specialized hydraulics, advanced sensors.
Robotic components for autonomous functions, yeah. When Deere upgrades its equipment, it demands higher quality, often more expensive, high-tech components.
So it's not just an increase in the volume of parts.
No, it's an increase in the quality and complexity of those parts.
And that focus on reliability for their long-term vision probably means these suppliers can get good long-term contracts.
It gives them strong revenue visibility, absolutely. And it raises the barrier to entry for their competitors.
The three companies here really reflect that. First is Illinois Tool Works, ticker ITW.
A very diversified supplier They're involved in advanced materials and fastening systems, which are critical for durable machinery.
Next is Honeywell International Inc., ticker HON.
A leader in controls, sensors, automation. I mean, they provide the brains for a lot of these precision ag machines.
And finally, Rockwell Automation, ticker ROK.
They're all about industrial automation and information solutions. They're like the nervous system for a modern factory or machine.
It really shows how far Deere's strategy reaches, from the field all the way back to the component maker.
It does.
Okay, now we have to look at the other side. The company's facing some pressure. The same factors that help one part of the market can definitely squeeze another.
Right. And we should start with the firms that are really sensitive to farmer psychology and trade policy. That's the crop input and commodity-dependent firms.
Now, why the pressure here? If farmers feel good enough to buy a new tractor, wouldn't they also spend on fertilizer?
Not always, not in the short term. The thing about tariffs and trade uncertainty is that they create a lot of volatility in crop prices.
Okay.
So even if a farmer has capital, they might see that uncertainty and decide to pull back on their variable costs. And the easiest variable cost to cut are inputs.
Things like fertilizer, pesticide.
Exactly. It's a much easier, quicker budget adjustment than, say, delaying a tractor upgrade that you know you need.
And that pressure goes straight to the margins of the input companies.
Straight to them. So our list here has Mosaic Co., that's MOS, and CF Industries Holdings, ticker CF.
Both are major fertilizer producers.
So they are extremely sensitive to any change in farmer spending habits on inputs.
Now, the next one on this list feels a little less direct, AGCO, ticker DEO. How does a beverage company fit in here?
The link is indirect, for sure, but it comes down to commodity risk in their supply chain.
Because they use agricultural products as core ingredients.
Grains, barley, fruits, you name it. And while they have very sophisticated ways of buying these things, sustained volatility in global ag markets,
Which is made worse by tariffs.
can really impact their raw material costs. It can create unexpected swings in their budget. The exposure is a latent risk when the ag market is this uncertain.
Okay, that makes sense. Let's move to the next group facing headwinds. Small and mid-sized machinery competitors.
When a giant like Deere focuses on these huge 2030 targets and advanced platforms, it gets very tough for the smaller guys to survive.
How so?
Well, they just can't match Deere's scale. Their purchasing power, their massive R&D budget for all this AgTech, it's just a different league.
So if tariffs raise the cost of steel, for example.
A smaller company might have to eat that cost or pass it on and become uncompetitive. Deere, with its huge buying power, can negotiate better prices on raw materials, and that gap just gets wider.
So their margins are getting squeezed by costs, and at the same time, they can't afford to innovate on the tech side.
That's the headwind. They're getting pinched from both sides.
Now, this list has a few names that we probably need to explain because they aren't direct competitors. We have Foundation Medicine, FMI, and Yeti Holdings, YETI.
Right, and the impact here is described as less direct. Let's start with FMI. It's a biotech firm.
So what's the connection?
It's about broader market sentiment. When ag budgets get tight because of trade wars and input costs, investor sentiment around related sectors like biotech that supports agricultural innovation get a little shaky. It's a classic case of capital pulling back from specialized areas when the bigger industry looks volatile.
So it's more about how investors see the health of the entire R&D environment connected to agriculture.
Precisely. And the inclusion of Yeti, ticker YETI, is even more about consumer behavior.
For their coolers and outdoor gear.
Yeah, that's discretionary spending. If farmers and other people in the agricultural economy are facing prolonged uncertainty, their spending on non-essential durable goods can drop. Yeti is seen as a potential tell for strained rural consumer spending.
And the last one here, Kansas City Southern, ticker KSU, is a more logical fit. It's about logistics.
KSU is very relevant. Its rail lines are crucial for moving bulk agricultural goods. If commodity volumes are impacted by tariffs or if investment slows down, the rail companies feel that volume reduction right away.
Lower shipments mean lower revenue.
It's that direct.
Okay, our final category focuses purely on those external cost risks. We're talking about industrial suppliers facing tariffs.
Yeah, we've established that trade policy is a major factor for industrial producers,
So these are suppliers who rely on imported components.
especially things like steel and specialty alloys. They're at immediate risk. If a tariff hits a key raw material they import, that cost hits their books immediately. You can't just retool your whole manufacturing line overnight.
And if they're selling to a massive buyer like Deere, They probably don't have a lot of leverage to just pass that cost increase along.
That is the core of margin compression. Buyers like Deere and Caterpillar negotiate hard. Suppliers often have to absorb a big chunk of that tariff increase just to keep the contract.
We see two pretty clear names here: Nucor Corp, ticker NUE, and United States Steel Corp, ticker X.
Yeah, they are right in the path of any trade dispute involving industrial materials. Very exposed to global steel pricing and demand.
And the third name is CNF Financial Corp, CFR. This one is a little different, more about the financial cycle.
CNF Financial has exposure to loans and financing in the manufacturing and small to mid-sized industrial sectors.
So if those smaller tariff-impacted suppliers start to struggle with their margins,
It creates stress in the whole financing ecosystem that supports them. CFR is on this list to show that even financial firms with some exposure to that supply chain can feel the downstream effects.
so to wrap it all up for you, the market is being pulled in two directions here.
It is. You've got this internal push from Deere's digital strategy, which is a tailwind for AgTech and high-tech component suppliers.
But then you have this external pressure.
The uncertainty of tariffs, commodity prices, and that's compressing margins for anyone tied to raw materials and really putting the squeeze on smaller companies that just can't match Deere's scale.
Before we go, let's leave you with an idea to think about. We talked a lot about the shift to digital farming. Beyond the companies we listed today, how does this long-term focus on connected machines influence the secondary market for older, non-connected equipment?
That's a great question. Does that older equipment suddenly lose its value because it's not smart?
Or does it maybe become a more affordable alternative for smaller farms that want to avoid those new software subscription models? Something to mull over.
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.